The GCC debt capital market issuance is expected to continue to rise through 2024-2025 and approach $1 trillion outstanding. Government issuances will be driven by expected lower oil prices and interest rates, as well as initiatives to develop the DCMs and further diversify funding channels. However, the rise is expected to be slower than in the first quarter of 2024. The bloc now accounts for around 30% of total emerging market dollar issuances excluding China. 4 out of 6 GCC sovereigns are investment grade and all are on stable outlook. Fitch upgraded Saudi Arabia, Qatar and Oman over the past 16 months. The GCC debt capital markets grew by 7% year-on-year, reaching around $940 billion outstanding at the end of the first quarter, with Sukuk having around 40% share. In 2023, dollar Sukuk issuance shot up by 212% year-on-year, outpacing bonds which grew by 68%. However, there is fragmentation across the bloc. Saudi Arabia is aiming to deepen its DCM, with issuance driven by budget deficits. We expect UAE issuance to continue in spite of surpluses. Qatar's and Oman's DCMs are expected to continue contracting, and we expect these governments to further repay debt in 2024. The debt law absence limits Kuwait's funding options. Amid wide deficits, Bahrain is dependent on DCM access and GCC funding. The GCC debt capital markets are in different stages of maturity and less established than more developed regions. The corporate funding culture is geared towards bank loans, and banks are reliant on deposit funding. More diverse and wider issuer and investor participation would support DCM development. Sukuk faces limited standardization and Sharia complexities.